I am going to be sharing an amazingly simple chart pattern that appears in almost all markets, and you can use this one pattern to successfully achieve financial freedom through trading. But before we start, be sure to hit that like button and subscribe to our channel, so that you don't miss on any of our new videos. With that being said, let's get into today's video. When we are new to trading, we often jump from one strategy to another in search of the perfect strategy that has massive profits and no losses. The truth is, there is no such strategy. Every strategy has its own pitfalls. The problem is, new traders take a lot of time to realize this, and they keep on jumping from one strategy to another. The best way to become a consistently profitable trader is to master one strategy. Do not trade 1,000 strategies at one time. Instead, trade one single setup 1,000 times, and I can guarantee you will become a profitable trader. So in this video, I will show you one simple setup that you can master to become a consistently profitable trader. The setup is called as a high tide flag pattern. The setup is nothing but a simple chart pattern that occurs in strong bullish stocks during their individual bull run. I first discovered this pattern in Williams O'Neill's book on how to make money in the stocks. If you haven't read the book, I sincerely recommend it. The time frame used for the pattern is the daily charts. Anyways, the way I trade this pattern is a little bit different from the book. This is how the pattern looks. The high tide flag pattern is nothing but a chart pattern that looks like a flag on its appearance. First, we see the price makes a strong 15 to 20% up move within 2 weeks. Then, the price makes a pullback and starts to consolidate for a few weeks. As you can see, the price creates this amazing flag pattern. If we see closely, the size of the candles during the consolidation pattern is very small. This means the volatility of the stock has reduced during this time period. Then, we see a strong breakout of the consolidation area with a big green candle. On this candle we shall enter a buy trade. An important point to note here is that the breakout candle should be a big green candle. The price move on the breakout day should be greater than 4%. This shows that the buyers have entered the market again, and the up move has also gained momentum. We will enter a buy trade at the close of such a day. I will go over the exact details of trade management a little bit later, but first let us be clear with the pattern. Oftentimes I like to use moving averages to confirm my setups. I use 3 exponential moving averages on this trade setup: the 10, 20, and 50-day EMA. When the high tide flag pattern appears, we want to see the pattern develop above all the 3 moving averages. We also want the 10 EMA to be above the 20 EMA, and the 20 EMA to be above the 50 EMA. In other words, we want the 3 EMAs to be sequentially lined upwards. All the 3 moving averages should also be sloped upwards. When the moving averages match our criteria, it gives us a clear indication that the price is in a strong uptrend. The basic purpose of using moving averages is to add confirmation to our existing bias. Now, let's look at some trade examples to understand the setup better. So here is the first example. On this chart, first of all, we see that the price made this strong up move over a time period of almost 2 weeks. The actual move was a 28.7% up move from this low to this high. If we look at the size of the candles throughout the up move, we can see that they were bigger compared to the prior candles. So, this shows that the buyers had suddenly bought the stock in huge quantities. Therefore, we expected the price to continue the up move for the long run. But after the up move, we see that price starts to consolidate for a period of 3 to 4 weeks. Over this period, we can clearly see that the price made a downward sloped flag pattern. Now, if we look at this area, we can see that the size of the candles during this consolidation were smaller than the candles during this up move. This signals that the down move right now is just because there has been some level of profit taking. If sellers were actively trying to sell during this time, the candles would have been bigger and the price would have moved lower. But because the price did not make a huge down move, this is an evidence that the down move is just because of profit taking by the people who bought here. Now, let's look at the moving averages. The price has stayed above the moving averages for the most part, and the EMAs are also sequentially lined upwards. The three EMAs are beautifully sloped upwards, which further confirms our uptrend bias. So now, we have a pretty good flag pattern developing here. On this candle, we see that the price breaks above the flag pattern. The breakout candle was a big green candle which made a strong 4.3% move on the breakout day. Even if we don't look at the exact percent move, we can clearly see that the size of the breakout candle was way bigger than the previous set of candles. Therefore, this was a good sign that the buyers had once again entered the trend, and we were ready for yet another up move. So, we enter on the close of this breakout candle. We will keep our stop loss exactly below the breakout candle, and we can easily target an 8 to 10% up move. To set our targets, we can calculate the previous up move and add it to the origin of the current up move. So, we can place targets around this area. The best part about this strategy is that our stop loss will generally be a lot smaller than our targets. In other words, we can achieve big risk-reward ratios. As you can see, we made profits on this trade. When you trade this setup, generally, the price will immediately move into profits. If the price goes sideways for a few candles, you should probably exit your positions. Let's look at another example. On this chart, we can see that the price made an 18% up move within 18 trading sessions, which roughly accounts for a month. In other words, the price made an 18% up move in a month. Then the price starts to consolidate for the next 2 weeks. This time the price created a pure sideways consolidation pattern with similar highs and higher lows. This creates an ascending triangle flag pattern. If we look at the moving averages, we can see that the price stayed above the moving averages for most of the time. The EMAs are sequentially lined up and all of them are sloped upwards. If we look closely, we can see that the price was also getting support at the 20-day moving average. This is also a positive sign that further confirms our upside bias. So we want to look for a breakout of the flag pattern. On this candle, we see that the price clearly broke above the flag pattern. The breakout candle was way bigger compared to the previous candles, as it made a 4.76% up move on that day. This was a clear sign that the buyers were about to push the prices upwards. So, we will initiate a buy trade at the close of this candle. We can keep our stop loss below the low of the breakout candle. For targets, we will calculate the length of the previous up move and extend it to the current breakout candle. This gives us a clear target that the price will most likely achieve. So we will target this price area. And as you can see, the price achieved our targets with ease. Let's look at one last example of this pattern. Here on this chart, we can see that the price made a strong up move of 33% over a period of 1.5 months. Then, the price made a retracement and it started to consolidate. The stock plotted a series of small range candles that eventually created this beautiful flag pattern. The moving averages were all sequentially lined up, and the price stayed above the EMAs for the most part. The EMAs were also sloped upwards, which further indicates a strong bullish trend. Now, all we need is a solid break above the pattern. On this candle we see the price breaks above flag pattern with a big green candle. The size of the breakout candle was evidently bigger than the prior candles. So we enter a buy trade on this candle. We can keep our stop loss below the breakout candle, and we can easily expect another 33% move. And as you can see, the price achieved our targets over the next few weeks. So that is it. I have shared with you a simple high-tight flag pattern that constantly occurs in the markets. My last suggestion to you is use this pattern only during bullish market sentiments. If the general markets are in a downtrend, then you should avoid trading these patterns. The best thing to do in bearish markets is to sit in cash and wait for the market to turn around. You should always consider the broader sentiments of the market before trading any stocks. That brings us to the end of this video. If you liked this video, then be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. See you soon.